What's up everyone, Ross here from Warrior Trading. In this episode, I'm gonna walk you through how to avoid false breakouts. In the last 5 days of trading, just in the last 5 days, we have had a couple of huge momentum stocks, and I've been doing well. I've been averaging over $13,000 a day for these last 5 days. I'm at $68,198.97 just in the last 5 days of trading. Almost $70,000 in 1 week. Now, some of the stocks that we traded, we saw some impressive range and some absolutely horrendous false breakouts, bull traps, and bear traps. And I saw a lot of traders do really well, but I also saw a lot of traders fall into the traps. So I wanted to make this special episode and review with you the 3 steps that I'm taking before jumping into a trade. This is especially important right now in this market where we've got a lot of volatility, we've got a lot of opportunity, but we have this inherent choppiness, and it's been more prevalent in the last 6 months than I've ever seen in my trading career. Some of these whips, and if you're watching this episode, you've probably seen them, where a stock, pops up, it starts to break out, it maybe looks like it's about to halt up, and then all of a sudden it whips back down. Now there's a couple of contributors to this, and I suppose it doesn't really matter too much to look into all of the details or speculate as to why this is happening. Most importantly is taking some steps to avoid getting caught in the traps so you can trade better. The goal of any beginner trader, naturally, is to try to find a couple of opportunities each day. And so I'm gonna show you a couple of the indicators that I'm using to help me focus on trading a stock where it has the most potential. And then therefore avoid trading the stock in the areas where it has less potential for profit, and then invariably higher likelihood of these bull traps that can catch you as a beginner trader. When you fall in, it is nasty. All right, so let's go ahead and jump in. I'm gonna switch over to the screen and we can start actually diving into the charts, and I go through the 3 steps I'm taking right now before jumping into a trade. All right, let's do it. So one of the first things that I've done is I've added an oscillating indicator to my charts. So typically when you look at my charts, you wouldn't see this indicator at the bottom. Typically you would see the candlesticks and then the volume right here, and you wouldn't see an additional indicator. But one of the things that I've kind of struggled with over the last few months with these really nasty false breakouts is, in the past, I would find myself trading a stock in this area here when it's sort of pulling back, and I'd be looking for that next move higher. The oscillator is helpful here because it reminds me that the stock is now sort of on the back side of this move. It was moving up, trending up very quickly, and now we're kind of reversing. And so really at this point, one of the biggest steps that I'm trying to focus on, and that I ask myself before I'm taking a trade, is this stock on the front side of the move, or is it on the back side of the move? And so the front side for me on this stock is everything before this candle right about here. So in this area, the stock is trending up. And this is one that we traded last week and did quite well on. And so you had a little uptrend here, a little sideways, another nice uptrend here, a little more sideways, more uptrend, and then it just started to pull away even faster. So these were the areas naturally where we had the most opportunity. I mean, and this is a stock that went up 100% in like an hour. This is exactly what I want to be looking at. Now remember, as a beginner trader, you're never going to capture the top and bottom of every move, but when you have a stock that goes up 100%, even if you only capture a fraction of that, a fraction of 100% is still a really nice move. If you're trading a stock that's just going sideways, a fraction of nothing is nothing. So you want to focus on stocks that are moving quickly. And so for me, this oscillating indicator gives me that added confirmation that this is a stock that's trending up. So what you see here, this kind of looks like a mountain range. And I like to see that the mountain ranges are getting bigger. And I like to only trade when this green line right here is above the red. So basically, based on the oscillator, the only areas that we would really want to focus would be right in here and then right in here. And so if we bring that up to the chart, it's basically this area here and this area here, right in here. And so if you focus on these areas right here, and then in the areas where the green is no longer visible, you're sitting out completely. You're not even trading it. And here's the problem. Look at this false breakout. This is case in point. See this false breakout right here? So if you had been using this indicator, and by the way, this is just simply MACD, a moving average convergence divergence indicator. It's just MACD, and I just colored it in this way so it's just easier to see. Basically, you could do different settings on this. Some people will use it as a histogram, and the histogram works the same. It's you would only be looking at it when it's green and not when it's red. But I actually leave the MACD line on, and then I put the signal line over it. So MACD, just for what it's worth, that's what we call it, MACD. So I'll just give you a quick example. So MACD, it stands for Moving Average Convergence Divergence Indicator. And so when a stock is moving up quickly, it's short moving averages, like for example, your 9 moving average, as you probably know, will move up really quickly with the stock as it's going higher, right? Your slower moving averages, like your 20, they're not as fast to pick up. And so what ends up happening is in this period right here, your moving averages, and so this is a measure of the relationship between 2 moving averages, a fast one and a slow one. And so what we're measuring is if they're diverging, which means they're moving apart, the space between them is getting bigger, or they're converging, which is what would be happening right through here. They would be converging. So when they're converging, this is a very easy representation that the stock, if it's converging and the space is getting tighter and tighter and tighter, then the stock clearly is coming into a range-bound area. Now, the reality is you can recognize this by looking at the chart, and yet so many traders will still end up falling into traps in a way because we sort of get this tunnel vision. And so one of the things that can be helpful with indicators is that they can add a little bit of a red light or green light. It's a cross check. So you're looking at a setup and you're thinking this looks good, but let me just cross check my other indicator. Now I want to be warning you that if you add too many indicators, you can get this analysis paralysis, where you've got so many indicators, you've begun confusing yourself. And it's not really possible in the very short time frame of taking a day trade to review 15 different indicators to see that they're all positive or that they're all confirming. So I do urge caution. I think it can be helpful to add 1 or maybe 2 additional indicators, but you don't want to put on too many because then you can get yourself into a little bit of this analysis paralysis. And by the way, at the very beginning of the episode, I talked about the trading over the last couple weeks that I've been doing. So I just wanted to throw this right down here. This is the $68,000 I've made in the last week of trading. So this is just in 1 week of trading. And I want to remind you guys, as always, in case you didn't know, that my results are not typical. This is real money. I trade with real money. This is a retirement account that I'm trading in. But you shouldn't assume that you're going to be able to do the same as me. I've been doing this for a really long time. All right, so I just wanted to say that before we go any further. Okay, so on AMTD, one of the things that happened was right at the open, we had this really nasty false breakout. Right? So the stock squeezes up here from 11 up to 12, up to almost 13. It drops then all the way to $9.45, and it gets halted going down. And I hate seeing traders, type, "Oh my God, I just got caught in the trap and I'm red on the day." Because to me, and I don't want to, I hesitate to say easy money, but relatively speaking, trading is not easy, but there are naturally going to be times where a stock is easier to trade than other times. And I find right now that the easier times to trade is when the momentum is the strongest, which means the stock is on the front side of the move. MACD is positive here. You've got your fast line, your signal is your MACD line is above the signal. You've got this divergence, and when it starts to cross back over, this is where we're seeing this inherent weakness. And when it's negative and the stock pops up, a lot of those pops are getting rejected really hard. So yes, you're getting a swing. You are getting a pop. And I suppose if you're really quick, you could have gotten in and gotten out of this and made money. But this is high risk. And as a beginner trader, you want to be focusing on the areas where you're more likely to have the wind at your back, momentum is on your side, you can get in, you can set your position, and you can let it work. And perhaps if you get in a little too high, you have the benefit that you're still on the front side, and there's a really good chance the first dip is going to get bought up. That's not going to be the case when you're trading it on the back side of the move. So this is just one example, and I'll go through a couple of examples during this episode. Now, the second indicator that I'm using to help me avoid false breakouts and getting caught in bull traps is to avoid trading stocks below the volume weighted average price. This probably goes without saying, but you've got all this price action right here, and I see a lot of traders who will say, "Hey Ross, does this look like a does this look like a good setup right in here?" And I'm looking at this and I'm thinking, no, it doesn't. It's below the volume weighted average price. It's basically at low of day. And while it's good to buy on support, you're buying something that is inherently shown a lot of weakness. And what happens is it starts to pop up a little bit, you get that topping tail, and then that hard rejection. And on a stock like this, where the volume weighted average price, where it tests it, look at this. This was a test and a massive rejection. So that's a false breakout. We had this false breakout right here. You've got another one right here. The whole time, your MACD is negative, right? So your moving average convergence divergence indicator is negative. So the stock is moving, this is not positioned positively for a trade. And this is regardless of the float. The float here could be 900,000 shares, it could be 9 million, it could be 90 million. On this type of stock, you have the technical characteristics working against you. It's on the backside of the move, it's clearly coming down. Are there going to be exceptions at times where you'll see something that, blows your mind and just does the exact opposite of what you expected? Sure. But my sort of opinion on this and my preference is, while I might miss a couple of trades that surprise us, if I can avoid getting caught in, 8 out of 10 false breakouts, I'm going to be in a much better place as a result. And so that means focusing on trading in these areas right here. So now let's look at another example. So we've got the three steps that I'm taking right now before I'm buying a position. I'm checking the MACD and I'm wanting to confirm that the oscillator is positive and that we're moving away. We're diverging, right? That tells me that's just a very quick red light, green light. The stock's moving away. This is a safer place to be trading it. Because sometimes you'll sit down and you'll look at it in this area where it's sort of pulling back and you're like, okay, maybe it's going to go back to the high. And right now, that's not a setup that is trustworthy. There's too many false breakouts when you're trading, when you're in this convergence type of positioning. So then the second is making sure I'm focusing on trading above volume weighted average price, which you certainly were. You're above volume weighted average price, all the way until this breakout right here. So that just trading above VWAP would not have kept you out of this false breakout. That's where you needed the MACD. And then the third sort of check that I'm doing before taking a trade is I'm asking myself, is this a stock that has a history already today of doing some nasty false breakouts, or perhaps from yesterday, if I recall from yesterday. And so once a stock has a reputation of being untrustworthy and doing these types of false breakouts, I'm much more likely to avoid it. In the class that I recently taught on algo scalping and how market makers and institutional trading algorithms work, we talked about the whips that these algorithms are fueling. They provide liquidity to the market with high frequency trading and the high frequency trading algorithms, but they also amplify volatility, the way these algorithms process orders that go into the market. So a big marketable sell order, for instance, on a stock like this can all of a sudden trigger the algorithm to pull the bids, and it can result in a dump. And so when you start seeing a stock showing this type of tendency, it tells me a couple things. Number one, it tells me that you've got some high frequency trading algorithms or market makers that are abusing retail traders on this particular stock. And I've got to put like a caution flag out at that's not trustworthy. Number two, there's the possible risk that there's insiders or somebody selling really big chunks of stock as marketable orders because it's creating those big flushes and those big rejections. And they don't care that they're getting 50 cents or $1 of slippage on their exit because they're in from such a good price, it doesn't matter. So that's a red flag. So if we see a stock that's shown a history of false breakouts, like for the rest of the day on this one, I would say it's not trustworthy. So it tries to get back over the VWAP right here. And it makes an effort, but now this is our third check. While your MACD is coming back up into positive territory and you are back above the VWAP, now this is a stock that already has that red flag, caution flag on it. It's had a history of false breakouts, therefore it's not trustworthy. And so it shouldn't have surprised you when you got this rejection right here from $10 straight down to $8.68 in one candle. So, if you bought this and you're like, oh, it's holding above VWAP, this looks like a nice clean trade, I'll buy this pullback, right here. Well, you've got topping tail here. So the candlestick by itself is already showing indecision. This was a bit of a topping tail. And then right here, basically out of nowhere, you get this $1.50 per share drop on 1,000,003 shares of volume. So that again to me is someone is dumping a huge position, and now anyone who bought this above the VWAP right in this area is trapped. They fell into the trap. So when a stock is proving it's not trustworthy, I leave it alone. Again here, see, it tries again, it comes up, you get that big topping tail, it's still not trustworthy. And I know so many traders who will just keep trading these stocks. They will trade them all day long. They'll get in, they'll get out, they'll get in, they'll get out. And listen, guys, I'm gonna be honest. This stock was only clean right back here at this part of the move. This was the only time it was clean. And if you missed it, you missed it. Wait for the next one. If you're over trading this, it's a stock where you've got the MACD against you, you've got this history of false breakouts, and at this point you're below the VWAP. Okay, let's look at another one, QNRX. All right, so this is another stock from just a couple days ago. We had a epic move on it. And this right here is gonna show you, again, let's just use the MACD to highlight the areas that we would wanna trade it. So MACD is positive from here to here, it goes negative, and then it comes back up to positive right through here through here. All right, so these are the areas where we're interested. And sorry, we've also got it back here, but this is at the very beginning of the move, so it's very possible you would have missed that early move. Okay, so these are the areas, and we can pull this down a little bit so you can see it better. Sorry. So these are the areas right in here where we're focusing. All right, and we can pull this down a little bit. All right. So this is the gut check. This is the red light, green light. The indicator here is saying, yes, this is worth looking at, it's worth considering. It doesn't mean blindly buy it just because your MACD is positive, but you can see this nice mountain range formation, the really steep move up. Now, obviously in this section where it goes from $13 to $28 a share, extremely volatile. It also comes all the way back down to like 17 before you have that actual crossover where the MACD goes below this red area. So it's not like you would just hold it until it goes negative. That's not the strategy at all. The strategy, of course, for those that aren't familiar, is to buy micro pullbacks. So if you don't know about the micro pullback strategy, I'll put a link right down in the description. I'll pin it in the comments. If you want to download my micro strategy PDF, you're welcome to download it. I've made that available for traders on YouTube for a long time. So check that out. And that's going to walk you through the actual strategy. So right now, we're not talking really specifically about entries, like the precise entry. We're not talking about the precise type of stock. At the end of this episode, I'll put a recommendation to a couple other videos that I have that go into those aspects of strategy in more detail, stock selection and entries and exits. Right now, I'm just talking about what can we do to avoid false breakouts. So number one here, focus on trading when the MACD is moving up. You've got this nice mountain range, this nice acceleration. The stock is moving quickly. This is all the front side of the move. And at this point right here, when it went negative, you would have been like, okay, is the move over? And here's what I would say. The fact is the stock was holding up very well. You've got a fairly big range here, but it's holding up quite well, okay? So that indicates that the move is not over yet. Yes, your moving averages have converged because you're in consolidation, but it hasn't like dropped hard. In this area here, I thought the move might have been done. I was like, okay, that might be it. But it rallied back up right here. And then as it rallied back up, this right here, first pullback, was an opportunity. Now, truth be told, you would have had to take, be a little bit brave to take that trade because the stock had just squeezed up pretty quickly. But at this point, it didn't have any strong history of false breakouts. At this point, for the most part, it was fairly clean. It breaks out here, it pops up, squeezes to a high of 13, it pulls back, it does halt down, then it rips back up. Again, in this area, this is all bullish. The dips are getting bought up and the dips are coming to the moving average. Yeah, sure, it's a big red candle, but it's coming right to the moving average, predictable support, and it's rallying back up. So micro pullback entry right here, you've got a micro pullback right here, you've got another one right in this area here. Then we go into a longer period of consolidation, which also ends up turning into a 5-minute chart. I am on the 1-minute chart right now, which for active day trading, I find just to be faster and therefore more helpful. So this right here ends up marking the top. Okay, so when the stock comes back down, probably about at this candle here, when you have that bigger breakdown, it indicates that, okay, we're not rallying back up. And you can see at this point, you did hold consolidation through this area, but now you've got a real decline in volume. We definitely rejected off the top. We had that topping tail candle. And the next day, it just, it tried a little bit, but it wasn't able to reclaim those levels. And at this area here, while you certainly could have taken this type of trade right through here, this would certainly have been higher risk on day 2 than trading it on day 1. Day 1 is usually when we're going to see the cleanest action. That's the type of area you want to focus on. So AMTD, that was a good example. QNRX, that was a pretty good example. ENVB, this was another one. Oh, APDN, this is another one also. APDN, this one had a really dramatic false breakout. And here was the red flag on this one. So right in this area, your mountain ranges here are not growing, they're not getting bigger. The mountain range is smaller right through here. This is a smaller increase back up. So you're not seeing this nice big expanding mountain range. And then you come in right here and look at this rejection. It goes to 7, up to a high of 725, 735, halts down instantly, flush. But it had already done something very similar right here, not quite as big, and it had also rejected really hard right here. And both of these rejections pulled back well below 9 moving average support. I mean, these came down hard. So this one, while it was above the VWAP and while the MACD was positive, what this one had was the history of false breakouts already before the big one. And the MACD wasn't as good of a profile as I would have preferred. And then ENVB, this is one that I was squeezing up the same day as QNRX. And on this one, again, the area to focus is front side of the move. So you've got this nice acceleration here. You've got your mountain ranges getting bigger. I will say that this one had quite a lot of range. It would pop up to a high of 857. It dropped down to 750, came back up, dropped back down. So very kind of jerky price action. And then it kind of pulls away. But this really was sympathy momentum to the move happening on QNRX. It was happening at the same time that QNRX was going to 28. So the sympathy momentum there, the important thing if you're trading sympathy momentum and you're kind of taking that approach is that when the stock that this has sympathy to starts to roll over and is dying, this one probably will as well. And don't expect it to go a lot higher, especially when it doesn't have any of its own real standalone catalyst. So here you have the moving average crossover, the MACD crossover. And so we were kind of clean to keep trading it through this area, but right there on that break, that was game over right there when it broke. And so it wouldn't have been worth trading it down here, trying to buy it down here. This is where it's high risk. So what I would focus on if I were a beginner trader right now is trading stocks on the front side of the move. When the MACD mountain range is moving higher, the MACD, the moving averages are diverging, they're moving away. You're having this rapid rate of change. That's classic momentum. Now, there may be days where we don't have something that's really, really strong like that. And that means as a beginner trader, you're probably better off trading in a simulator on that day and waiting for the next one that's really strong. You want to focus on trading stocks that are above the volume weighted average price, of course, more bullish, therefore, and you want to focus on avoiding stocks that have a history already of showing false breakouts or bull traps, because if they've done it once, they will do it again, right? There's a reason that they've done it once, whether it was a big seller and the market makers abusing retail traders, whatever the real cause is, the price action speaks for itself. So when a stock is no longer trustworthy, you gotta let it go, break up and say, I'm done with you. I can't trust you and I'm not going back. I'm waiting for the next one. You don't have to take trades on every stock that's moving, and you don't need to trade for 8 hours a day. If I'm gonna be honest, let's just switch back to the whiteboard. This is the reality of trading. If you can make 20 cents, if you can make 20 cents a day, 20 cents a day per share, right? You do that with 100 shares, you're up 20 bucks, all right? You've got 20 bucks at 20 cents. If you do it with 1,000 shares, you've got 200 bucks. Now, if you could do it with 5,000 shares, you've got 1,000 bucks, all right? There you go, so small zeros. So I want to encourage you to keep this goal at the center of what you're thinking about. 20 cents a day, 20 cents a day. And so where can I find my 20 cents a day with the least amount of risk possible? And I want you to go back and look at some of these charts. It's going to be trading the front side of the move and using these oscillating indicators like MACD. If you chose to use something else, that's fine. This is what I happen to like right now. You're going to find that these are the areas where the price action is the cleanest. So this is where you want to trade it. That's when you've got the green light to trade, to be aggressive, to try to find your 20 cents. And when the MACD has crossed over the signal and it's negative, leave it alone. When you're on the backside of the move, leave it alone. Wait for the next one. Less is more. If this episode was helpful, I hope you hit the thumbs up. I hope you're subscribed to the channel. And I want to put a couple episodes right here that you can check out. I'll put them right up here and right there. We're going to talk more about strategy in those 2 episodes. And remember, down below, I pinned to the comments and in the description the link to download my micro pullback PDF. So check out this episode on the beginner strategy, the best strategy for beginner traders. And you can check out this one right down here for scalp trading. All right, check out those 2 episodes, and I hope you keep learning, keep studying. It's a lot of fun, but as always, trading is risky. So make sure you take it slow. All right, practice in a simulator before you put real money on the line. And remember, there is no guarantee that you'll find success, whether you trade on your own or you learn from me. So just take it slow and practice in a simulator. All right, thanks for tuning in, and I'll see you for the next episode.